Every great civilization builds temples. Some rise from stone, others from steel and glass. But the temples that shape our modern world aren't built to honor gods. They're built to guard money. Step into any city skyline and you'll see them, towering buildings with marble pillars and quiet confidence. Banks, they don't make food, they don't build machines, and they don't grow crops. Yet somehow, everything depends on them. Every paycheck, every mortgage, every government, every dream of prosperity, all flow through these silent vaults. Most people think banks simply store money. That's the illusion, one that's been carefully maintained for centuries. In truth, banks don't just hold wealth, they create it. Long before skyscrapers and spreadsheets, money was gold, heavy, scarce, and trusted. Merchants traveling across Europe or the Middle East couldn't risk carrying it all, so they began leaving their gold with goldsmiths, who offered safekeeping in secure vaults. In return, the goldsmiths issued paper receipts, promises that the bearer could reclaim their gold at any time. Those receipts started circulating as money themselves. People trusted the paper because they trusted the promise. And soon, something extraordinary happened. The goldsmiths realized most people never came back for their coins. So they began lending out a portion of the gold that wasn't being claimed, issuing more receipts than the gold they actually held. It was the birth of fractional reserve banking, the art of creating money out of promises. The gold never multiplied, but the receipts did. Every loan created new money in circulation, backed not by metal but by faith. And that's when banking became less about storage and more about creation, less about gold, more about trust. Every depositor believes their money is sitting safely in the bank, waiting to be withdrawn. But if all depositors tried to withdraw at once, the illusion would collapse instantly. That's what's called a bank run, when confidence breaks. It's happened countless times from 17th century London to 21st century Silicon Valley. In reality, when you deposit $1,000, the bank keeps a small fraction, maybe $100, and lends the rest out. The borrower spends it, and whoever receives it deposits it again, repeating the process. Your $1,000 becomes $10,000 in the economy, multiplied through loans. That's how banks expand the money supply. Not by printing bills, that's the central bank's job, but by creating credit. Credit is invisible money, born when someone borrows and destroyed when they repay. And because almost every dollar in circulation exists as credit, the entire financial system floats on an ocean of debt. At its core, banking is not about metal or paper. It's about belief. When you swipe a card or send a wire, no money physically moves. What moves is information backed by trust that the promise will be honored. This system works beautifully when everyone believes. But when belief falters, everything freezes. That's why governments and central banks spend so much time reassuring the public that the system is safe. Because if trust breaks, so does the economy. The last time that trust truly collapsed was 2008. Banks had created mountains of risky loans, wrapped them in financial jargon, and sold them around the world. When borrowers defaulted, the illusion of stability shattered. Within weeks, the global economy teetered on the edge. Governments rushed to rescue the same banks that caused the disaster, not because they deserved saving, but because without them, the system itself would collapse. That's the dark paradox of banking. It's too fragile to fail, yet too powerful to control. To understand how banks shape your life, look at what happens when they stop lending. Every business expansion, every home purchase, every new factory, all begin with a loan. Banks are the engine that converts confidence into capital. They don't just move money through the economy. They create the oxygen it breathes. But this power has a price. Because when credit expands too far, bubbles form. When it contracts, recessions begin. That's why central banks, the banks of banks Grumpus created, to stabilize this delicate balance between trust and panic. In the United States, it's the Federal Reserve. In Europe, the European Central Bank. Their job is to control interest rates, influence lending, and act as lender of last resort when fear spreads. But even they don't truly control money. They guide emotion. They manipulate confidence. They whisper to markets, and markets move. Most people think governments rule banks. In reality, the relationship is symbiotic. Governments borrow from banks by issuing bonds. Banks buy those bonds using deposits, the same deposits citizens think are safely stored. In turn, governments protect banks with regulations, bailouts, and guarantees. It's a closed loop of mutual dependence. When governments run deficits, banks profit by lending them money. When banks struggle, governments borrow more to save them. The system sustains itself by creating more debt. A self-feeding cycle where credit is both lifeblood and poison. And because almost all money is born from debt, there can never be enough to repay it all. For every dollar created, someone owes interest. To pay that interest, more money must be created through more loans, more debt, more promises. It's not a bug, it's the design. Why do people accept this fragile system? Because it works, until it doesn't. For most of history, people have traded trust for convenience. Carrying gold was risky. Hoarding cash was inefficient. Banking made commerce faster, smoother, and safer, at least on the surface. And as economies grew, people stopped asking how banks worked. They became invisible, part of the background of modern life. But every so often, a crisis forces people to look again. When banks fail, they don't just destroy money, they destroy belief. That's why after every crash, governments rush to restore faith. Deposit insurance, central bank guarantees, stimulus packages. It's all about one thing: rebuilding trust so the system can restart. The system that powers our prosperity also locks us into perpetual debt. Every time a bank issues a loan, it expands money supply and inflates prices. Homes become unaffordable. Education grows expensive. Governments borrow endlessly to fund programs. And yet, the more money flows, the more dependent we become on the system creating it. It's a treadmill of credit. Step off and the economy slows, run faster and inflation rises. That's why politicians fear recessions more than anything. And they expose how fragile the engine really is. Money is not neutral. Whoever controls its creation controls everything. Banks don't just manage finance, they shape societies. They decide who gets a loan and who doesn't, what industries grow, what dreams live or die. They are invisible architects of civilization, and through them, power consolidates quietly. When credit flows freely, wealth concentrates. When it stops, chaos spreads. That's why every empire, from Rome to America, builds its dominance on financial innovation, and often on the illusion of stability that banking creates. In the end, banking is a story of cycles: creation and collapse, confidence and fear, expansion and contraction. Every crisis, every boom, every bailout stems from the same simple truth. Our money is built on promises. When those promises are kept, prosperity thrives. When they're broken, everything burns.